Brian. Thanks for joining us.
Hello, Sarah. How are you?
Doing all right. Trying to make sense of this turnaround. It looks like your numbers were good for this morning. The cleanest of the bunch, I'm told. Profits, revenues, better net interest, income climbing 29%. How sustainable are these numbers given the economic environment we're walking into?
Well, we had 85 cents a share, which is an increase over last year, an increase linked quarter. You saw NII pick up year to year, $3 billion plus. And so we've locked in the economic, the rate recovery and the rates going up, and that will go forward. But, our core prediction at Bank of America is for a mild recession in early 23 to mid 23. And our Candace Browning-Platt and the research team, which you have lots of colleagues on a given year, have been there pretty consistently. So, but it's going to, everything we see, it'll be a mild recession, and therefore we and the rest of the industry, which are in great shape on capital, liquidity, and everything, ought to power through it and be able to stand and be ready to deliver for our customers. And so we feel pretty good about that. Will it be a little more interesting? Yes. Will it be a little different? Yes, because the stimulus and stuff that when the economy, still a lot of it's still sitting there. But, we feel very good about our position. We feel very, very good about the team and how they performed.
You said mild recession, and you mentioned that on the earnings call as well. And so did some of your colleagues at the other banks. Why are you so convinced that it will be mild if the Fed just keeps plowing forward with these rate hikes into a pretty sharply inverted yield curve?
Well, what we're seeing is, the Fed, as I've said to you in prior interviews, the Fed is faced with a challenge to bring inflation down, and you're seeing some of the indicia of that inflation tipping over, and that's good. And yet there's parts of it they're still worrisome, and so they're trying to get it right, and they've got to be more ardent about fighting inflation than anything else, because that's the job they have that honestly nobody else has. And so they're going to keep working. They've been resolute. I think that they're going to hold rates high for long. They've been clear about that. But incrementally, the impact of the rate structure has come up dramatically to where it is today. And so the incremental from here to higher rates to 5.25, which is what we have predicted for the terminal rate, that is that's from where we are now, that's a bit, but not as much from zero up to there that we've got in the fours. So I think the next impact will still be there. The length which they hold it will be there. But what gives us confidence is look at employment levels, look at wage earning levels, look at consumer spending levels. And yes, they're starting to come down, and they've come down, but they're still consistent with a low inflation, growing economy. And as long as American consumers are in pretty good shape, America will be in pretty good shape.
Yeah, I wanted to ask about an update on the consumer. You said on the call that you still see a cushion there, and the consumer is still in healthy shape, even if slowing. So give us more color, if you could, as to what you're seeing and what you expect, and just how big that cushion is.
Well, think about a couple different aspects. What are consumers doing on a day-to-day basis? In the first quarter of 2022, they were spending 14% more in the first quarter of 22 versus 21. That is now back down to about 5% in the fourth quarter of 22 versus the fourth quarter of 21. That is more consistent with a low inflation, modestly growing economy. And then what they spend on is switched from goods to experiences, travel, out to eat, things like that. And so that's moved along, going to movies, going to concerts, things they hadn't been able to do and now are fully set up. So you've seen that change. And then travel is obviously increasing. So that spending has come down to be more consistent where it was in 16, 17, 18, 19 as the Fed raised rates, but there was this normal level of spending. That's good news and bad news. Bad news is this is slowing down, and the Fed has pushed the consumer to be a little more conservative, and the environment has. Yeah. But the good news is they're still spending consistent with growth. That's why I think we believe. The second part is, do they have money to spend? And if you look in the balance of our accounts, well, they've been working their way down slightly. They're still sitting with multiples for the median income consumer, multiples of where they were pre-pandemic for the same consumer come out a bunch of years. So then the third is, are they able to cash flow and pay? And they're employed, and wage growth is still strong, even though it's flattened out a bit, and that's good news. And so you put all that together, that's pretty good. And then you go to the question of their borrowing, and you can see delinquencies are coming up, and people are saying, oh my gosh, they're rising. But they're still not near where they were in 19, which is among the best consumer credit statistics our company has had in its history. So you're still not near normal. And that means, yes, they're getting worse, but incrementally, in a broad base of consumers, you're not seeing the stress yet. So those are all bode well, but it's all slowed down, and that means the Fed may be able to slow down and be more probative about which way they want to go.